Welcome to this explainer. If you love digging into the mechanics of massive global businesses, you are absolutely in the right place. Today, we're zooming in on AXA SA, the French multinational insurance giant. We're going to break down their incredibly strong first half 2026 performance, analyze where they sit in the market right now, and look at their strategic road ahead. There's this really fascinating tension happening right now between the company's powerful internal momentum and some very real external market headwinds, and we are going to map the whole thing out together.
Just a quick heads up before we dive into the numbers. This explainer is strictly for educational and informational purposes, based entirely on publicly available data as of August 2026. This isn't financial advice. Always do your own research and consult with a professional financial advisor before you make any investment decisions. All right, here's our roadmap for today. We'll be hitting the H1 2026 financial highlights, breaking down the business, checking out the market reaction and valuation, diving into analyst sentiment and strength, looking at their strategic moves for growth, and wrapping up with risks and the road ahead. Let's get into it.
Section 1. H1 2026 Financial Highlights.
So, on July 31st, AXA dropped their H1 numbers. And CEO Thomas Burrell, who, by the way, was just overwhelmingly reappointed by shareholders in April for another 4-year term, called the results outstanding. When you look at the raw data, well, it's pretty easy to see why. AXA reported total gross written premiums and other revenues hitting an immense 66.3 billion euros. That's a really solid 5% year-over-year jump. And that top-line growth, it cascaded straight down to the bottom line, driving a 9% rise in net income at constant exchange rates to 4.2 billion euros. We also saw their underlying earnings per share grow by 8% to 2.19 euros. That is absolutely crucial, because it places them at the very top end of their 6 to 8% target range. They aren't just hitting their goals, guys, they are maximizing them.
Now, here's a profitability metric you definitely want to pay attention to: an 18% return on equity. When you compare this across the broader financial sector, this figure stands significantly higher than many of AXA's industry peers. It really shows a highly efficient use of shareholder capital. Basically, it proves that the sheer scale of their revenue isn't coming at the cost of their profit margins. But the real question is, how well protected are those profits? Well, that brings us to their Solvency II ratio, which is sitting at 218%, up from 211% previously. Now, in the insurance world, this is your vital financial fortress metric. It measures an insurer's capital strength and their ability to absorb massive unexpected losses. At 218%, AXA is demonstrating massive capital strength, and that provides some serious peace of mind for both policyholders and investors.
Section 2. Breaking down the business. Okay, to understand how they generated over 66 billion euros in just 6 months, we really need to look under the hood. We need to see exactly which geographic regions and business lines are driving this momentum, and which ones are kind of dragging. This breakdown tells a really clear story. The absolute standout performer right now is the life and health segment. Premiums are up a fantastic 8%, and earnings rose 11%, driven by positive net flows and margin expansion. Property and casualty is also pulling its weight with a solid 3% growth. And what's really fascinating here is that management noted they are already actively using artificial intelligence to improve loss ratios and overall productivity in that P&C segment. Pretty cool, right? But it's not all perfect. The reinsurance business is lagging. It's down 9%. Fitch Ratings had actually warned about this, pointing to falling prices and lower transaction volumes across the broader reinsurance market. But honestly, despite that headwind, AXA's overall picture is incredibly robust, with literally every single geographic region contributing to their strong bottom line.
Section 3. Market reaction and valuation.
So, pivoting from AXA's internal financial success to external market reality, over the past year, the stock has traded within a 52-week range of roughly 36 to 45 euros. But here's the central mystery we really need to unpack today. How exactly has the broader market reacted to these fundamentally strong, record-breaking profits? You'd expect a straight upward trajectory, right? But the reality of the stock market is rarely that simple.
When we look closer, it paints a rather complex picture. Over the last year, AXA has actually delivered a stellar 15.36% total return for shareholders. In fact, over a recent 90-day stretch, the stock was up nearly 10%. But since hitting a mid-August high, the stock suddenly dropped about 8%. So why the sudden dip? Well, it literally has nothing to do with their balance sheet. The drop is tied almost entirely to broad market volatility caused by the ongoing political crisis in Paris, which has heavily weighed on French assets across the board. It's an external shock.
And that politically driven sell-off brings us to a really eye-opening valuation. At its current price of around €44.91, AXA's price-to-earnings, or PE ratio, is sitting at just 9.13. Think about that. For a company at the top of its target earnings range, with an 18% return on equity, a PE of 9 is a valuation that a lot of market observers suggest completely ignores the underlying fundamental strength of the actual business.
Section 4. Analyst sentiment and strength.
To see if the professionals actually agree with this market disconnect, let's look at a recent survey of 17 major analysts. And wow, it reveals overwhelming bullishness. 15 of these analysts rate AXA as a buy, just 3 rate it as a hold, and that includes a downgrade by DZ Bank that looks like a solitary outlier, and there are exactly 0 sell ratings. None. Wall Street is clearly looking straight past the current political noise in France and focusing squarely on AXA's cash flow and growth engine.
When we check out the specific price targets issued in early August, the conviction is really clear. Morgan Stanley sees the stock going to €48, Goldman Sachs is at €48.50, and Jefferies recently bumped their target up to a bullish €52. Overall, the consensus 12-month average target sits at €50.51. That implies roughly a 12.5% upside from current levels. And Berenberg Bank, they've even reiterated a massive $88.10 target for the US-traded ADR.
And the big credit agencies are completely aligned with this strength too. On August 19th, Fitch affirmed their AA rating for AXA, pointing to their leading business profile and massive capital base. Standard & Poor's also has them at a AA rating, and Moody's rates them at AA2. Across the board, all 3 have a stable outlook. They are basically cementing AXA as one of the safest, most reliably capitalized insurance companies on the planet.
Section 5. Strategic moves for growth. So, with a foundation that's solid, how is management actually using these deep pockets and high credit ratings to expand the business? Well, they certainly aren't sitting still. AXA has been on an incredibly aggressive strategic timeline lately. In mid-August, they dropped €500 million to take a 51% controlling stake in Italy's direct insurance group Prima, which massively strengthens their position in the Italian motor insurance market. Then, just over a week later, their Hong Kong and Macau arms signed a huge 10-year lease for nearly 100,000 square feet in West Kowloon, setting up a massive flagship wealth management center to move into by early 2028. All of this aggressive positioning is building toward a huge, highly anticipated catalyst: the presentation of their brand new 2027 to 2029 strategic plan, which drops on September 15th. We already know organic growth, AI efficiency, and disciplined capital management are going to be the core pillars there.
Section 6. Risks and the road ahead.
Now, to truly understand the company's position, we have to weigh all those ambitious growth strategies against the macroeconomic threats that are looming on the horizon, and this breakdown illustrates that balance perfectly. On the risk side, we absolutely have to acknowledge the ongoing European political volatility, which has already proven it can pressure the stock price. Plus, as an insurer, climate-related losses, like the recent devastating wildfires in France and Spain, are a constant growing threat, right alongside that continuous pricing pressure in the reinsurance sector we talked about earlier. But juxtapose those external risks against AXA's massive internal buffers. They have a highly diversified global business model that prevents them from being totally reliant on any single region. They've got that bulletproof AA balance sheet, and, perhaps most exciting for investors, management expects to launch an annual share buyback program of up to €1.25 billion. That puts a serious floor under the stock price.
So, as we wrap up our analysis today, I want to leave you with this thought. AXA is a company delivering outstanding top-of-range earnings, fortified by world-class capital strength, yet it's trading at a PE of just 9.13 because of macro-political fears. With that massive September 15th strategic plan fast approaching, you really have to ask yourself, is the market severely mispricing AXA right now? Is this politically driven dip actually a hidden opportunity? It's a fascinating question, and one I highly encourage you to explore further as you do your own research. Thank you so much for joining me to unpack this explainer today, and keep learning.